Hey everybody, and welcome to this Greico financial training course, and welcome to our introduction to the industry. Here we're going to paint you a picture of what is the financial industry. So whether you are a multi-decade industry veteran or someone who just got hired this morning and is being introduced to the word finance today, this will give you a nice primer for, well, the rest of the course as we try to imbue the ideas, the concepts, the knowledge that'll get you across this test and further in your career. Thank you very much. I'll see you guys on the other side. Welcome to this Greico financial training course. Let's begin with an introduction to the industry. Before we do this, let's discuss a little bit about what you will be doing as you watch these courses. Our courses are designed to appeal to all different learning styles, whether you're an audio learner, a tactile learner, or a visual learner. If you're an audio learner, we will be giving you a lot of lectures and songs and jokes. Just sit back, listen, enjoy the show. If you're a visual learner, we're going to have a lot of stimulating visuals done in different colors in order to make the experience more captivating and memorable. If you're a tactile learner, we encourage you to write down notes as you watch the class. We structured our visuals in order to make it really easy to take notes and structure them effectively. We also have follow-on workbooks as a separate additional purchase, which make it even easier to take notes as you watch the class. Welcome to the financial industry, which is really split up into two different parts. There is the primary market where companies go to raise money. The way this is done is that they'll reach out to investment banks who will walk them through all the steps to raise the money by issuing stocks or bonds to the public. And the money received is the money that the company uses to start up. Once these securities like stocks are issued, investors who bought them begin to trade them amongst each other. This is called the secondary market, where investors buy and sell from each other on stock exchanges and other trading venues. Let's continue the story and learn some more. Hey everybody, this is Alex Merced and welcome back. So as you just heard, we're going to be going over an introduction to the industry. So let's, well, get on that. So basically, on your paper or in your workbook, you'll notice there's a line down the middle. Now, basically, this represents the two parts of the industry, which includes the primary market. Now, the question we have to ask ourselves about the primary market is, what is the primary purpose of Wall Street? Because the primary market is the reason why Wall Street exists. It exists for the purpose of raising money for companies. So when you take a look at your smartphone, companies like Samsung and Apple had to raise money to create the things that we enjoy that make our lives better, etc. But that money doesn't just come from thin air. It's got to come from investors. And that's what Wall Street's here for, helping companies find investors so they can raise money. But how do we do it? Well, the way we do this is we're going to create items, objects, contracts that represent ownership in a company. You probably know them as stock. We'll create contracts or items, arrangements that represent debt from a company. So basically the company owes you money. This is called a bond. But stocks and bonds are both known as securities that we then sell to the public, and when the public pays for those securities, that money goes to the company, which they can then use to hire people, buy equipment, do all the things to create the enterprises that make your life better. So how do we do this? We're going to create securities and we're going to be selling them to the public. But what kind of terms should we always be thinking about when it comes to the primary market, when it comes to selling new securities such as new stocks, new bonds to the public to raise money for a company? Well, let's think of the primary market. We think investment banking. Okay, investment banks. These are broker-dealers who are mainly set up to help companies raise money by issuing securities. Now, these investment banks, you can think of them as doing syndicate. Okay, basically getting together with other investment banks to work together to sell these securities, forming a syndicate. You can think of this as underwriting. In going out to sell the securities of the company, they are assuming risk. There's a possible chance, depending on how they set up the deal, that the company, if they cannot sell the shares of an Apple or a Samsung, that they're stuck with the shares and have to give Apple and Samsung the money for them. So whenever you assume risk, we refer to that as underwriting. In the same way an insurance company underwrites the risks of any insurance policies that you undertake. So investment banks on Wall Street create securities for companies. They sell them in bunches called syndicates. This whole process is called underwriting. And we're selling it into what we refer to as the new issue marketplace, the primary market, where new issues are sold to the public, new securities. We call this the IPO marketplace. Because when a company sells stock to the public for the very first time, we call that an IPO, an initial public offering. So whenever you see these terms, you always want to think primary market. This is where companies raise money. This is where investment banks create securities and sell them to the public. Now here's the thing. If you go back to the 1920s, we didn't have the internet like we have it now. I couldn't just hop on Yahoo Finance or your favorite financial website and look up the stats of your favorite company. And back in those days, the only way for me to get information was from my broker. And they didn't necessarily always give all the information necessary to make an informed decision. So after the great stock market crash in 1929 that started the events that kind of was a Great Depression, Congress passed several laws, and one of those laws was the Securities Act of 1933, which basically said, before you sell those securities to the public, you need to create a brochure that tells you everything about those securities. And before you give investors that brochure, that prospectus, us, the government, would like to look at it first. So you're going to file a registration with the government. The part of the government that does this is called the SEC, the Securities Exchange Commission. That's the SEC. They oversee the securities industry on behalf of the government. So we're going to file our registration, let them look at our copy of the prospectus under the Act of 33. Now, by law, as described in the Act of 33, the SEC must take 20 days. So that means that the earliest, they could take longer, the earliest that the SEC could give us an answer on whether everything in the brochure, in the prospectus, looks good, it has all the information the investor needs, the earliest they can get that declaration of effectiveness is on day 21. But when that happens, when the SEC says, hey, everything looks good, feel free to go ahead and sell these new securities, the minute we sell these securities to the public, everyone in the public begins playing hot potato with the stocks that they bought, the bonds that they bought. They begin trading them amongst each other. And this is called the secondary market. This is where the security that we created now begins to trade between investors who are like, oh, sweet, I just bought this new stock at $20 at POP, the public offering price. Now I'm going to go into the market and see if I can find someone who's willing to pay me a higher market price for the security I bought. Okay? Basically, all those who have the stock selling to those who don't have the stock. Haves selling to the have-nots. The question is where? Okay, it's not like I can go down to my local grocery store and find stock on the shelf next to Tide or cereal or anything like that. There's actually special marketplaces where securities trade among investors. And again, all of these places are part of the secondary market. Okay, so where does the security begin to trade? Well, the bigger the market capitalization, meaning the more value all the different shares of the company have, the higher level marketing venue or trading venue that they can be on. Okay, think of this like a band. When you first start a band, you start playing like dive bars, but as you build up a bigger following, you can start playing places like Madison Square Garden. Same thing for a stock. In the early days, when they first start out, they don't have much market cap. There isn't that many people trading the stock isn't worth so much, so they're not going to be able to get onto the larger trading venues. Okay? So one of the smallest trading venues, as we look at them from smallest to largest, will be pink sheets. Okay, so we'll move on from pink sheets and the over-the-counter bulletin board where stocks that are not listed, meaning they're not on an official exchange, trade. So basically, if you're trading here, there's a chance that there may not be many buyers and sellers, which is reflected in the price of your stock, your market capitalization. So in this case, when you buy unlisted stocks trading at Pink Cheese and Bulletin Board, there may not be liquidity. What's liquidity mean? It means the ability for me to sell my securities, my assets, quickly at a fair value. Okay? Everything can be sold. My iPhone can be sold. If I said to somebody, hey, want to buy my iPhone for $1, I'd probably find a buyer very quickly. So I sold it quickly. But a dollar is not the fair value of the phone. For something to be liquid, you have to be able to sell it quickly at a value that the market deems fair, which means there's got to be a lot of buyers and sellers. So as your company grows and more people begin to trade your stock, so there's more buyers, more sellers, its market cap is going to grow because those buyers and sellers are going to reflect larger and larger and larger market prices. And then you'll be able to list on exchanges such as NASDAQ Capital Markets, which is sort of the smallest rung on the NASDAQ ladder. Then you can go up to NASDAQ Global, and the top rung at NASDAQ is NASDAQ Global Select, which you can put on the same level with the New York Stock Exchange VARs. The stringency of their listing requirements, meaning of the rules you got to meet in order to be on the exchange. So this is a nice little overview of the industry. Primary market, again, where we sell new securities to the public. Why? Because we need to raise money for companies. And we got the secondary market, where the security created begins to trade, and it trades at different venues based on its size, based on its market capitalization. Now, what's going to happen is that we need to start a company. We have a great idea. We're going to start a company called Greico Air, a regional airliner that basically wants to grow, it wants to expand, so that way it can compete with the likes of JetBlue. So it's going to have a fun catchphrase that they want to outdo the blue. So what we're going to do now is we're going to help Greico Air raise the money that it needs in order to start this cool airline and so it can outdo the blue. Now, basically, all the people over there at Greico Air, they were doing their calculations on how much money it's going to cost for pilots, for marketing, for all the relationships with the different airports or planes, etc. And they came up with a number of $900 million that they're going to need to get this venture off the ground. So they go to a bank, but banks want a lot of collateral for a loan, so that didn't quite work out. Eventually, they met some investment bankers who said, you know what, how about this? You propose the idea to us, and if we like the idea, if we think this is something that the investors that we have relationships with would be interested in, we'll help you create the security and then sell it to the public. So all you got to do is come meet us in our investment banking conference room. So here we are live from the investment banking conference room, meeting with the investment bankers over there at JG Capital, here with all of us at Greico Air. Now, once again, the idea is that Greico Air wants to raise money. How much money? Greico Air wants to raise $900 million. Okay, we want to raise $900 million so that way we can expand domestically, so that way we can build up this airliner nice and big. Now, how many shares is that going to take? Well, luckily the team over there at the investment bank, they have a whole bunch of analysts who can help us with this. So again, remember, the investment banking team is going to be presenting us all the steps to raise money for Greico Air and eventually take it public. And again, Greico Air is a local carrier that needs money to expand its business domestically from regional carrier to national carrier. So all the analysts over there at JG Capital, they started crunching numbers, doing fancy things like discounting cash flows and predicting future cash flows, things we don't need to worry about right now. But what is the end result? They say, you know what, we think we can issue Greico Air by selling 45 million shares of Series A voting stock. Okay, and this is common stock. So we're basically selling 45 million shares of ownership in the company, and we think we can sell them at a price of $20 a piece. That's called the public offering price. So whenever you create a new security, a new stock, or a new bond, and you sell it to the public, what price does the public pay? POP, Do they pay anything more? No. Do they pay anything less? No. They always pay POP. And for this example, we set the POP at $20. Now, the thing is that as the investment bank builds their relationship with Greico Air, the first part of that relationship, there's always two legs. There's the part where you're acting as the advisor, meaning helping them walk through the steps to create the security, do all the legal work regarding the security. Then there's a second leg where you're acting as an underwriter and actually going out and selling the security to the public. So what does it mean to be the investment bank acting as an advisor? Well, it means that you're going to really walk them through all the legal steps of figuring out what registrations you need to have, how should they structure the deal, what the fees should be, etc. Okay, so we're going to hire an investment bank to act as an advisor. And they're going to provide a full range of services to the issuer, the company who's raising money. So whenever I say issuer, think of the company who's raising money. Okay, but the advisor, the investment bank who's acting as an advisor, is going to provide the following services. They're going to walk you through all the steps to raise the money. So we're going to walk through all these steps of how to legally create a deal, all the different considerations that go into it. They're going to give advice regarding restructuring the company to restore profitability and efficiency, because you may have a cool business model, but because of the way you're structured, like where your office is, means you have to pay so many taxes here, and you could be more profitable if we restructure how you're taxed, where you're located, what your debt looks like. They're going to give you an idea of how to make your company as lean and mean as possible, so that way you provide the most value to investors as possible. Okay? And that restructuring hopefully will be able to help you raise lots of money without losing ownership or control, figuring out what's sort of the best way to structure the deal that you're going to sell to the public. Now, once the advisor's done their job, you're going to need underwriters to go out and sell the security. Investment banks are going to go out there and meet investors that they have relationships with and sell the securities. The thing is, sometimes for really big deals, the investment bank doesn't want to do it by themselves. So they'll form a team, a group of investment banks who are going to go out there and sell that security to the public. And they're generally referred to as the syndicate. So when I think syndicate, I'm thinking many different investment banks working together to sell the security to the public. Now, let's talk a little bit about how the syndicate is generally structured. So again, to diversify risk, investment banks will form underwriting groups or syndicates. Okay, teams of investment banks. They're going out there to sell the security. Now, let's see how one looks like. So here we have an underwriting group. So think of each corner of the trapezoid as a different investment bank who's part of the team. Now, the problem is there's got to be someone who's making decisions regarding all this. So there's got to be one member of the syndicate who's kind of in charge. So every syndicate, once they form, has to make a decision. Okay, they have to choose or elect someone to act as the manager of the syndicate or the lead underwriter. Okay, so there's the manager, the book runner, and the idea is that they are making all the day-to-day decisions regarding syndicate. They are running the book of orders. So as each syndicate member sells securities to the public, it's the manager of the syndicate who's keeping track of a central list of all the orders from the different members. So that way, when everything is said and done and they actually distribute the stock to whoever bought it, there's a master list so we can make sure we distribute it correctly. And because of that, that lead underwriter, that syndicate manager, gets paid a little bit more. They're going to get paid a little extra, what's called a management fee. Now, again, the role of the manager is the issuer will select a lead manager early in the process. There is a lot of competition between investment banks for these positions because you get paid a little bit more. So, you know, it's good to be the king. You get to make the decisions, you get paid a little bit more. Who doesn't want to be a lead underwriter? Now, what happens is early on in the process, a letter of intent is created. Okay, and this is a non-binding agreement between the issuer and the investment bank that allows a manager to conduct due diligence, verification of all info. Basically, the idea is if I'm the investment bank and I'm creating your registration documents, I want to make sure that everything is right because I'm legally liable for anything I submit to the government on your behalf. So in that case, with the letter of intent, the issuer is saying, okay, here, I'm opening up all my information so that way you can find the information you need to make sure that everything's accurate so that way no one has to get in trouble. Okay, because it's all going to be on what's called our S1 filing with the SEC. So we want to make sure that's all nice and good. a syndicate agreement is created. And a syndicate agreement, also known as an agreement among underwriters, this is going to be the agreement among the different members of the syndicate. This is what creates the syndicates. All the different members say, okay, we're going to be a team. Here's what each team member is responsible for, etc. Okay, so this is the agreement among underwriters that determines the percentages to sell. Responsibilities, compensation, so what's each person going to get paid, how much are they supposed to sell? Are they supposed to sell 15% of the deal or 50% of the deal? All that's detailed in the syndicate agreement. Also, who is the syndicate manager would be detailed in there as well. Okay, now how does the syndicate get paid? Because if we can only charge them POP and not a penny more, how's there any money for the syndicate to make? Well, the way it works is if we charge each customer POP, which we mentioned was $20, from each share that we sell at POP, we'll take a little bit off the top. We'll say $1. Okay, and that $1 is called the underwriting spread. So for every $20 share we sell at POP, we're going to take $1 from that 20 bucks. The other 19 will go to Greico Air, and the dollar will go to JG Capital and the rest of the syndicate, which they will split up. But that $1, that underwriting spread, gets split up among a couple different things. Okay, part of it is going to go to the syndicate. That's called the concession. That's the part that goes to whoever's selling the security. Okay, and then another piece goes to the syndicate members for doing the underwriting, for assuming the risk. That's called the underwriting fee. So those get shared among all the different members of the syndicate. Okay, the underwriting fee and the concession, which goes for the sale. But there's going to be a small piece that's a little extra for the manager, and that's called the manager's fee. Okay? So again, that lead underwriters, they're going to get paid, and that's going to be generally, let's say 20%. Okay, and again, 20% for the underwriting fee, and then we'll leave 60% for the concession, which goes to pay for whoever's selling the security. And then we split the underwriting spread among those three areas. So again, we take the $20 POP, we take $1 off the top, that's the underwriting spread. We're going to give a little bit to the syndicate manager, the management fee. We're going to give a little bit to the investment banks who took some risk, the underwriting fee. And then we're going to give a little bit to whoever sold the security, the concession. And then that's kind of how the compensation works. Now, there's still more to talk about when it comes to raising money, because again, as we mentioned, JG Capital, the investment bank, is going to walk us through all the steps to raise the money. And the very first step is choosing a business structure. We got to set up the entity, because I can't sell shares of an idea, so I got to sell shares of a corporation, sell shares of a limited partnership, sell shares of an LLC. So what are my different options, and why would I choose one versus the other? So first, let's go through our different options, and then what we'll do is we'll see which one is the best choice for doing a public issuance of 45 million shares that we're going to do for Greico Air. So one option is a sole proprietorship. Now, a sole proprietorship means doing business under my social security number. So no one has to file anything. If I wanted to start a business today, I could just go out there and just start doing business and say all the tax ramifications go to my social. No filing, easy to set up. I just go out and do business. The problem is if there's any legal liability from doing business, so I make some sort of mistake and now I'm getting sued, they're suing me and I'm personally liable. So I have unlimited liability. They can take cars, houses, whatever, liquidate whatever they have to, garnish my wages, take my tax return, do whatever they got to do to pay out those settlements, those claims, etc. if I'm on the wrong side of a legal lawsuit. So we generally want to stay away from unlimited liability if we can help it. Now another option we have is a general partnership. So maybe me and a buddy want to start a business, so we start a partnership. Now, the paperwork, there is a little bit. We have to create a partnership agreement between each other, and we have to file a certificate of partnership with the state, telling the state that the partnership exists. But in this particular partnership, both of us are what's called a general partner. And since both of us are general partners, both of us have control in the day-to-day decisions of the company, we both have unlimited liability. So we can still be sued, still lose everything, have our wages garnished, have our tax return, have liens on it, all sorts of really bad things if we're not careful. So maybe that's not my favorite choice. Now I could also start a limited partnership. Now in a limited partnership, I'm still filing the certificate of partnership with the state. I'm still creating a partnership agreement among the different partners. But some partners will be called general partners who can run the company, and some partners will be called limited partners who don't run the company. And if you don't run the company, you're not liable. Meaning we cannot come after your car, your house, garnish your wages, your taxes. We can't touch you. Only thing you can lose is what you invested. So you invest $1,000, worst thing that can happen is it goes to zero. But nothing else will be touched. You have limited liability. You can only lose what you invest if you're a limited partner in a limited partnership. That's pretty good, but if I want to run the company, I still need to take on unlimited liability as a general partner. Maybe there's a better option. Well, that's where we have limited liability companies, an LLC. Now, in this case, I don't have to file a certificate of partnership. Instead, I file a certificate of organization with the state. And the cool thing about an LLC is that I can have as many different people who are owners, but now they're called members, and all of them have limited liability whether they run the company or not. So I can have unlimited investors who all have limited liability. This is pretty cool. I like this LLC structure, but it still may not necessarily be the best choice for a large public offering. Maybe we want to do what's called incorporating. The beauty of a corporation is that we separate the owners from the company from the runners of the company, the management of the company. Because in an LLC, I can have as many investors as I want, but everyone can make decisions, and everyone's kind of involved in all the decision making. So having too many investors can still result in too many chefs in the kitchen. But with a corporation, what happens is that anyone who owns a piece of the company is called a shareholder. And the shareholders don't run the company. The shareholders cannot make day-to-day decisions. What they can do is they can elect a board of directors, and the board of directors can then appoint people to run the day-to-day, which are called officers, like the chief operating officer, COO, the chief executive officer, the CEO, and that's the beauty of a corporation. We're separating who owns the company from who runs the company. Okay, it's a two-tier system, and we love it. But there's two types of corporations. There is the S corporation, and like any corporation, you're going to have to file an articles of incorporation with the state. You're going to file an articles of incorporation with the state. And the thing with an S corp is you're going to have a maximum of 100 shareholders. That's why we're going to think of S for small corporation. But the beauty is those 100 shareholders can all have limited liability. They all can only lose what they invested. So that's the beauty of that. And then there's probably the best choice for Greico Air, which is a C corporation, okay, which we'll go into in a moment. But all the ones we've mentioned so far, they all have what's called flow-through taxation, okay, which means if you're an investor in any of these, sole prop, general, limited liability, LLC, S corporation, at the end of the year, you're going to get documents from the company that tells you how much money you made, and you have to report how much money you've made to the IRS, even though you've never gotten any cash. It's just you've made the money on paper. You now have to report it to the IRS and pay taxes on it, which means you only get taxed once, which is nice, because C corporations, as we'll see, they get taxed twice. Because instead of you having to pay taxes on your tax return, each year the company, as it makes profits, will pay taxes on its own return, and you only have to pay taxes is if you receive a dividend from the company, or if you sell your stock in the company at a higher price, called a capital gain. But that's if it's a C Corp. But a C Corp is going to be our favorite choice for a Greico Air. Mainly because we do love that corporate two-tier structure. We love the fact that we separated management of the company, the CEO, the CFO, the board of directors, from the owners of the company. So this is nice separation. Okay, yes, we have double taxation, but we're also not limited to how many investors we can have like an S Corp. Because in an S Corp, you're only limited to, well, 100 shareholders. With a C Corp, you can have unlimited shareholders while you file the same articles of incorporation with the state. Okay, and that's exactly how you create a corporation. You have to file the articles of incorporation with the Department of State in that state. Okay, and that's kind of how that goes. So how does an articles of incorporation look like? You're going to need to file in order to create a corporation, which is filed with the Department of State, as we mentioned. There are certain terms that you need to learn when it comes to the articles of incorporation, and one of those terms is the authorized number of shares. These are not shares that exist yet, but they can exist. They're the shares that can be authorized or are authorized for future issuance. So in this case, we're going to authorize 180 million shares. Doesn't mean they exist yet, just means they can exist. So how many shares will Greico Air ever have? 180 million. Does it necessarily have them today? Maybe not yet. Let's take a look. So the actual shares we've actually gone out and issued and sold to the public to raise money, they're called our issued shares. Okay, shares issued to raise the money. Now in this case, as we discussed earlier, based on our analysts over there at the investment bank, we've issued 45 million shares so far. So 45 million shares have been issued by for Greico Air to raise money, which we issued at a POP of $20. Okay, and we issue 45 million shares at that POP of $20 a share. That equals the $900 million that we wanted to raise for Greico Air when we started out the story. Now, in the future, the company may decide to buy back its own shares, maybe because it wants to push up the stock price, because lower supply means higher price. It could do it because it wants to prevent itself from being delisted. There are a lot of reasons why a company may want to buy back its own shares. This was very popular in the years after 2008 financial crisis, mainly because a few years afterwards there was this thing called the fiscal cliff, where taxes on investment income went up a little bit. Okay, before you would have long-term capital gains, 15%, taxation on dividends, 15%, and that all went up to 20%. So it became less appetizing to receive a dividend since you were being taxed a little bit more. And companies had a lot of profits and no obvious places to invest them because the economy wasn't doing so well. So as a company, I have a choice. We have all these profits at the end of the year. Now, if I thought there was really good places to reinvest the money, I'd reinvest the money and give my investors a return. If not, then it may make more sense. Or if I can give my investors a better return by paying them a dividend, giving them cash at the end of the year, then I would do that. Problem is, with the new higher tax rates on that, that return doesn't look so good. But I don't necessarily have an alternative investment to make because the economy was a little bit uncertain. So how do we give shareholders value? Basically the value of the dividend without giving them the dividend and resulting in tax consequences. Well, you bought shares back. You did share buybacks. So you'd buy back shares of the company in the market, and they would basically go out of circulation because these shares are known as treasury shares, and these are shares that the company buys back. And they're essentially out of circulation. They don't get a dividend. They're not counted as earnings per share. They're not counted as part of the outstanding shares. It's like they don't exist. And what happens when the supply of something shrinks? If there's less of something, it becomes more valuable. So theoretically, by spending the same amount of money they would have been on a dividend, the stock price will go up by pretty much what the dividend would have been, and they capture that value without having to pay taxes, because you don't pay taxes on an increase in your share price until you sell it, while you pay taxes on a dividend when you receive it. So that's one reason why a company may want to do a shareholder buyback and buy back shares of the company. But for whatever reason, they buy back shares of the company. Now, we just started Greico Air, okay, and generally, so it doesn't have any profit sitting in treasury yet to spend on buying share of the company because we literally just started the company. So in that case, we're going to buy back 0 shares at this point. So if Greico Air has issued 45 million shares and bought back 0 of them, doesn't that mean there's still, let me think about this. If I take the issued shares minus the treasury shares, that should equal the outstanding shares, the shares that are available for trading here and now. Those are the shares that do get a dividend, that do get counted in earnings per share, that do get counted as, well, outstanding shares, and they do get the vote. So I take the 45 million shares issued minus the 0 shares bought back, so we have 45 million shares outstanding. Nice! So that means 45 million shares represent ownership in the company. So if you wanted to own 100% of the company and have all the decision-making power, you just need to buy those 45 million shares. You want to get all the dividend, you need to own those 45 million shares. That's what it would take right now. If you own 50% of the company, it means you own half of those 45 million shares, because those are the only shares that exist right now. Now, we could issue more because we have more authorized shares, but the only shares that currently exist, that are currently circulating, that currently get the vote, that currently get a dividend, are the outstanding shares. And how do I calculate that? Issued shares minus treasury shares equals outstanding shares. I minus T equals O. Wait a second, doesn't that spell the name of my favorite judge from the OJ trial, Judge Ito, here to help us pass the Series 7? I think it does. That's why we're going to call this the Ito rule. Okay, the Ito rule. Issued shares minus treasury shares equals outstanding shares. And with filing the Articles of Incorporation, we have created our legal entity and now can go out there and raise money. Now, we can raise money in different ways. We can raise money by issuing common stock. We can raise money by issuing preferred stock. We can raise money by issuing bonds, whatever is most appropriate for that company, which will be determined by the investment banks. But with that, this gives you a good introduction to the industry, where we've learned about the two parts of the industry, the primary market and the secondary market. We've learned about basically what an advisor is, basically advising the issuer to help structure the issue, and then eventually hiring an underwriter to go out and sell the issue. And then in order to, well, have shares of something to sell, we need to create a legal entity to go out and sell it. So we gave you a nice taste of what the industry is. We're going to learn so much more in the videos to come. I'll see you then.